Hello, let us look at equity, which is one of the elements in the statement of financial position, basically the balance sheet. And equity is what is left of a business assets after deducting the liabilities. How? Recall the accounting equation, which was assets is equals to liabilities plus equity. Okay, if you take liabilities on the other side, you're going to see that equity is equivalent to the assets of a business, minus the liabilities of that business. Okay, that is why we are saying it is what is left of a business assets after deducting the liabilities. Okay, let us look at the components of equity to get an understanding of what makes up equity. Okay, and the first component is capital contributions. Capital contributions is the money or the other assets introduced into the business by the owner of that business. Okay, so for example, if I am to start a business for buying and selling cups, okay, and I remove the money from my own pocket, I inject into the business to buy stock, the initial stock, that is what we are calling capital contributions. And this capital contribution has different names depending on the structure of a business. So let us look at how it is called when we have a sole proprietorship, we have a partnership or a corporation, because you're going to see different terms being used depending on the structure of a business, so that you come to understand all these will be the same as just what is capital contribution. Okay, so in sole proprietorship, where basically we have one owner of that business, it is called owner's equity. Okay, owner's equity. Okay, and for partnership, that is for a business that is owned by one or two or more people who have come into a partnership and agreed, okay, we're going to share profit or loss of this business. They call it partnership. Partnership contributions. Okay, partnership contributions. Okay, and for corporations, that is for incorporated companies that has shares, whether private or public. Private is where it's just limited to specific people. Could be a family that owns a business and each member of the family has some shares, or just few people come together and form a business and they share. They have each has a specific number of shares they own of that business. Okay, that's a private owner, a private business. Okay, private corporation. But a public one, it is one that is listed and it's being traded in a security exchange. Okay, so for both of these scenarios, we call the capital contribution is what we call shareholders equity. Shareholders equity. So in depending on the case scenario of the business, you're going to see these terminologies. These mean capital contributions. Okay, it's just they have different names depending on the structure of that business. Okay, now let us look at the second component, which is retained earnings. And retained earnings is profit kept in the business. Okay, so for this business, I've gone and bought cups. Okay, and then I've gone and sold them. Definitely I've sold them at a higher price than how I bought them. Okay, so I have sales revenue. So I have revenue in this case minus expenses. There is a cost of sale, which is the cost of buying those cups. Okay, and there could be other expenses, operating expenses. That is, if I'm staying at a physical place, like I've rented a place, I have rent expense, I have electricity bill. Okay, all those expenses also are included. Okay, when you take that revenue of that business minus the expense, you're going to get something we call net profit, and this net profit is what we are calling the retained earnings. Okay, they are called the retained earnings. So a business can use these retained earnings to expand the business. Okay, or just hold it in the business for future use. Okay, In all the scenarios, whether it's a sole proprietorship, partnership, or corporations, retained earnings, the name retained earnings is used in all, okay? They don't have different names. We call them retained earnings, okay? Now, let us look at the third component, which is withdrawals. And withdrawals is money or other assets taken out of the business by the owner for personal use. Definitely, when someone starts a business which is for profit, the intention is to earn from it, the business to run, and then they benefit from having opened that business or running that business. So they are going to be withdrawals, okay? So if they are making profit, if it is a sole proprietorship like this, buying and selling cabs, I get to a point I see, oh, I've made this amount of money, maybe 100K. That is the net profit. And I'm like, okay, let me withdraw 50K to use in my personal use. That is what we are calling withdrawals. And withdrawals, they reduce the equity, okay? So for sole proprietorship, these withdrawals are what we call drawings. Remember, someone can be withdrawing money or just taking the assets of a business, like other assets. Like you could take an equipment and use it for personal use. That is a drawing, okay? And for partnership, we call them partnership drawings. Partnership drawings, okay? Same case, withdrawing money from the business for person use. For instance, here when we have the partners, we can withdraw money from the business, okay? And then for corporations, we call these dividends, okay? Commonly, like for listed companies, there is usually an amount of money that is paid to the shareholders at the end of the year after the annual audit and the AGM. And then they decide this is what we have. We are going to pay the shareholders dividends. So this is what is paid for corporations, okay? Yes, so those are the three main components of equity. This is what you input into the business, and then this is what it adds. Retained earnings actually add into the capital, into your capital, only if it is making profit. If it is making a loss, it reduces the capital. If the business is making a loss, your capital reduces. And then for withdrawals, they will always reduce your equity because you are withdrawing, okay?